Welcome. Thanks for joining us here on Berman's Call. Here to take your questions on stocks and ETFs today. Here's how to reach us toll free, 1-855-326-6266. You can also email us at bermanscall@bnnbloomberg.ca. Larry, good to have you in. Thanks for coming in. Let's start talking about this agreement of sorts with U.S. and China. It's really just a pause, but they've deeply reduced the rates of the tariffs so far on most things. Some of them, they're pausing for 90 days. Did you expect this kind of cut from this quick weekend series of meetings?
I did not expect a deal. We don't have a deal. We have an agreement to pause and
some talks
not escalate, talks to come. I think it's very, very complex. I don't think there's anybody that could tell you with a high degree of confidence how this is ultimately going to play out. But what it seems to me is that there's going to be a base rate of tariffs no matter what, everywhere.
And the base rate you think will likely be in and around the 10%?
Well, that's where they started. If you remember on Liberation Day, he started with a 10% number and the markets cheered. That's all? Great, we can handle that. Right? Markets rallied up. And then he came out with his board and everything went down.
Yeah.
So I think the markets are comfortable with that. It does not mean that that isn't inflationary or a headwind to growth. And so that's the aspect of what's likely to happen to the real economy that the market isn't paying any attention to today. It's cheering the news is better than expected. And so, okay, animal spirits. Animal spirits can last for a long time and be very irrational at times. So maybe that's a bit what we're seeing now. I don't think it's the green light to say, okay, get back in the pool, all is good.
I also want to ask you about the concept of the 90-day pause, which he's done a few times now. Okay, well, you know, we're going to introduce this, we're going to shock the system, and then we'll take a step back for 90 days. Doesn't that really just kick the uncertainty, kick the can down the road, which means that overhang lasts longer?
Well, yes. So it pushes everything back. So if we were going to get a recession, that recession gets pushed back a little bit. It will be interesting to see later this week when we start getting the hardline data, CPI, PPI, and retail sales for April, because those numbers will have an impact because consumers in April already started to respond to the market volatility and the uncertainty.
The more reflective.
Right, more reflective. So those data points in the next few days will be very interesting. What I'm looking at a lot this week is Walmart's earnings and what Walmart has to say, because X out all the trade, Walmart is one of the single largest trading partners with China on the planet. So what they have to say, not colored by the administration, not colored by political spin, but from a company that is right in the fire line to see what they have to say. I think that, to me, that's my focus of the week.
What do you expect?
Well, again, I'm not a trade expert in that sense. I'm a technical guy. I'm a trader and an investor.
In a wider perspective.
I think Walmart's going to say good progress. But the word uncertainty is very high in every CEO's vocabulary these days. And so it'll be interesting for me to see if they say we have some clarity. I don't think they can say that because they don't. Now, it was never going to be 125 and 145. That was never going to be a thing because literally, as they said, that is an embargo. Like there's no trade going on at all. So what is the level going to be and how is that impactful for margins, for corporations? How much is going to get passed through by way of consumer inflation? Those things are still uncertain. And it's hard for CEOs to make a business decision when you have that overhanging. And that's just now been elongated. So
because of that, what are you looking at for market growth? Because, as you said, everything gets delayed. If there's a recession, it gets delayed. If everything's 90 days, 90 days, 90 days, what happens to market growth in that scenario?
Well, so market growth and then economic growth. Related but different things. Market multiple can move around on animal spirits up and down.
Okay.
Right? We saw that get very depressed a month ago, and we saw it recover when they, changed the policy. But what is the economic growth going to be? Because they're still expecting, 8% earnings growth this year. I'm not sure we have the economic climate to deliver that. So I think on balance, earnings are going to be disappointing. But right now, the U.S. is still at full employment, and we have not really seen any of the hard data. Soft data, yes. This is why on retail sales, we saw the weekly credit card billings. We saw all those sort of fast things that we get more frequent updates on start to actually change in April. Okay. So that's, those data points too are going to be very interesting.
Got it. All right, coming up next, we'll get to your phone calls and your emails. Here's the number to reach us. There's time to give us a call with your question for Larry Berman, 1-855-326-6266. We're back in a moment. Welcome back to Berman's Call. We're here with Larry Berman to take your questions. First, an email from Dan. He says, I have some money in BMO's ZMMK. I use this for holding cash. I'd like to put it to work when opportunities present. Would you please suggest some sleep at night alternatives that offer a high yield? I like the sleep at night special part of that. What would be something you could get into here?
So that definition of that is without risk or with less risk. So everybody wants more yield and not willing to take the risk to do it. So that's a challenge because it really doesn't exist. Now, within the money market framework and within the BMO framework, there's some premium products. So BMO has a ZST, which is like a corporate money market. So they buy short-term corporate bonds, which tend to yield a little bit more than the government equivalents and gives a little bit of a premium, very safe short-term corporate bond. So, but what you're doing here is you're assuming a little bit of credit risk because it's a corporate bond, not a government bond.
Okay.
And therefore a little bit riskier. But when I say a little bit, I'm like, they're not buying, junk bonds to juice the yield. They're buying high-grade corporate bonds. And so that would be the replacement, and you're adding maybe 30 basis points. There is no more. Okay. Right? Like the safe, I don't want to take risk, but I need my cash. That's about the best out there right now, the ZST ETF.
Got it. Okay, let's get to the phone lines. We have Tom on the line from Kingston, Ontario. Hi, Tom.
Yes, good afternoon. This is my first foray into both ETFs and crypto at the same time. So I've been doing a bit of research looking at some of the different ones where you have things like Grayscale that seems to be about 1.5 or 0.15. Some of the others run up, seem to go up as high as 0.25. I'm wondering how I look at I'm looking at Ethereum specifically. I'm wondering how I might go about looking at selecting the right ETF or ETH.
Yeah, so good question. So the answer is, what are you trying to accomplish? Is this a long-term buy and hold for you? And if it is, you're never going to trade it. Find the one that is the cheapest in terms of MER, and that one will have your lower fees for a long term. If you're going to be an active trader, you want to have the one that is typically the deepest with the tightest spreads in terms of the bid ask, because if you're going to be in and out a lot, you don't want something with a wider spread where you're paying too much to trade it around. You want one with the largest or near largest market cap. You don't want a new entrant into the market if they're competing to get in, like on a cheaper fee, for example, right? So it really depends. And then the other part I think you were asking about was leverage, and the question is, I can't answer that for you. You've got to make sure how they use the leverage. Is the daily rebalancing of that leverage going to erode your net asset value? So those are the things that I would look at. And I can't give you a recommendation because I don't recommend Bitcoin or Ethereum or coin-based ETFs because I don't recommend them for clients. I think they're volatile assets that may or may not be worth a lot of money one day, but they're volatile assets. And for the average client, certainly of Q Wealth, it's not something that I would recommend unless you can handle the ride, and the volatility there is higher than almost any stock you could possibly put in your portfolio, maybe with the exception of some junior mining companies or some penny stocks.
Okay, so if you are investing in that, you definitely have to have the stomach for it, and you have to watch it.
Especially if you're using leverage.
Got it. Okay. Let's go back to the phone lines. We have on the line now Andre from Chilliwack in BC. Hi, Andre.
Oh, how are you, Mirella? You look very nice in red today.
Thank you very much.
Canada.
Thank you very much.
Yes, Larry, quickly, I don't want to be redundant, but people are asking about your best idea for a money market ETF. You've already mentioned it, so maybe you could find something that gives me 4%. I have 2 years before I sell my book and say goodbye, and we'll go off into the world and sail around the world. Thanks, Larry. Bye-bye.
Thanks for the question.
So again, here's another question about, I want a higher yield. I want something more tax efficient than a money market where I'm paying full tax rate. I've said many times the covered call an option-based strategy that converts a lot of income into more favorable income, because when you use options to get that extra yield in your portfolio, it's tax efficient. Okay, it gets taxed as a capital gain instead of a dividend.
Okay.
So you can use a ZPay, for example, and get exposure to the US market with a lot less risk and a tax efficient distribution. But it's equity market risk. It's not safe money market. ZWU, which is utilities, telcos, pipelines in Canada. Again, 7% plus yield. It's got less correlation with the overall markets, but it's equity risk. And so you can build a portfolio of option-based ETFs generating tax-efficient income from all over the world and generate a little bit less volatility with the same type of exposure, and then complement it for your short-term needs for the next year or two or three of your money that you need now and you don't want exposed to long-term equity risk with that ZST. And then once a year, rebalance some money out of the equity risk, put it into your safe ZST, and then get the highest yield available in Canada in a money market type safe security. And then just use that as your mix. And the more you think you need short-term, the more ZST you have, but expose it to equity growth and tax-efficient income coming off the equity market. I like that. I like that strategy very much.
Okay, good one for him to understand and know. Let's go back to the phone lines. Carmelina on the line from Montreal. Hi, Carmelina.
Hi, Mirella. Hi, Larry. I'm looking for some ETFs that hold preferred shares with good dividends. I don't know if you can recommend some.
Okay, let's have a look at that. Larry, so preferred share ETFs.
Yeah, so BMO's got a ZPR. There's equivalents that iShare has. There's one that Malva Hill has, Global X, HPR, and there's some tax benefits around some of those. So, have a look at them. If you did a simple Google search, preferred ETFs Canada, you'll find a bunch of them. And then you've got to find the one that works for you. So I don't have a recommendation in terms of, which one, because for my firm, Q Wealth, we have our own preferred security that I think is superior to many of these in terms of what it offers for clients. So we don't use them for our clients at the moment. But HPR is a very good one. ZPR is a very good one. CPD is a very good one. They all have slightly different exposures and different tax implications, and you kind of got to figure out which one suits.
Are they sector specific, or are they?
One's more market cap focused. One's a bit more equal weight. I think there's some tax benefits to the Horizon one. It might be part of their corporate class structure and so forth. So have a look at those.
Got it. Okay, let's get to an email. A caller from Newmarket, Ontario. Vanny is calling. Hi, Vanny.
Hey, hi, Berman. Thanks for taking my call. My goal is to have, monthly income, and I've been looking at some of these covered call ETFs. For example, there's a one like CONY in the U.S., which goes by Coney. And then we have, the HDIX in Canada, right? I mean, all I wanted to check is basically what is the feedback for ETFs like Coney? What is the difference and risk between ETFs like HDIV and XDIV?
Yeah, so it's a very good question. So CONY is an ETF with an option wrapper that gives you exposure to Coinbase. So the company Coinbase, C-O-N in the U.S., C-O-I-N in the U.S., and with an option wrapper to generate extra yield.
Okay.
For volatile stocks, like this is a single stock exposure, some of those other ETFs you mentioned are far more diversified exposure. So again, the answer is, what are you seeking? Are you seeking high potential returns and you're okay with a lot more volatility, in which case some of these single stock linked ETFs might be appropriate.
Okay.
I'm not recommending you do that. Might be appropriate depending on your needs. The ones that are broadly more diversified that give you, again, dividend covered call overall are great because you're diversifying. So do you want a concentrated sector like financials only, where if there's a lot of growth, you may not necessarily see those perform particularly well compared to covered call technology.
Okay.
Right?
So it depends on how long you want to hold it, is what it comes down to, right?
It always depends sometimes on a market call. So I'm not saying 1, 2, or 3 are appropriate. I'm saying I love the asset class in general and kind of learn how to use all of them together and build a more diversified approach. And so you can go to a ZWC that gives you pretty much the whole TSX 60 with a covered call.
Okay.
Right? Or something as broad as that. Being in Canada, very tax efficient in terms of the dividend and the income coming off the portfolio. So again, is it taxable? Is it registered? A lot more questions to unpack there in terms of which are appropriate. But I think those are the considerations, especially if you're talking about some of these single company ones where you got a lot more risk and a lot more volatility.
Okay. Let's go to an email from Iman. He said, I bought Enbridge after its $9 billion acquisition a few years ago, holding it for its good dividend. However, I see its price is stagnating. Should I sell it and invest elsewhere? We did look up Enbridge earlier today, and it's been hovering around 61-ish there. It's down today, $2.43. And it took the dive that everybody took, sort of end of April or mid-April there. What do you think of Enbridge? I mean, a lot of people do hold on to it just for the dividend.
I have no problem at all with dividend investing. So if you're doing that, Canadian good dividend, quality dividend payers are great. The risk is what happened to BCE. You know, I can talk about that for a second, where they finally cut their dividend. That was inevitable because the dividend got so big that they couldn't afford to pay it. And they were literally borrowing money to pay the dividend, which is just a bad business model. So you have to be careful when you're picking individual stocks, and you don't want them to get too big, even though for long periods of time they're great, and then all of a sudden they're not. Like BCE is a great example of that. So those are some of the considerations. In terms of Enbridge, again, a fine run company. But for the most part, so is BCE until very recently, where maybe they made some bad business decisions or whatever. Okay, again, parent of the station, you know, and I don't want to disparage anyone in particular.
We talk about it. It's the parent company of the channel, and yeah.
Fair enough. I love ZWU because it gives you Enbridge, it gives you BCE, you get a diversified approach to some of the best dividend payers in Canada and the US with a covered call overlay for that extra income. So have a look at ZWU.
Got it. All right. We are going to take a quick break. We'll be back with Larry's educational segment. That's next.
Larry Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Welcome back to Berman's Call. We're here with Larry Berman. It's time for his educational segment. Larry, now a 90-day pause on the tariffs that affect trade between China and the U.S. We're seeing a number of these pauses. What are you looking at in this interim period?
Yeah, so off the top, we covered this a little bit, but I've got a couple charts here I want to dig into a little bit, because the market after today's rally, the broad U.S. market is almost recovered to where it started the year. And I've got a chart on that, and I'll show that in a minute. I want to look at the economically sensitive sectors of transports, logistics, and the retail consumer. So there's 3 ETFs here, and we can bring them all up here on the chart. We can have a look at them. And in addition, XPO being a logistics company and Walmart. And this is why I said it's really important we look at Walmart, because all these other ETFs and XPO, which is one of the top logistics, again, bringing the products to market, they're all still well down on the year, even though the broader market has pretty much recovered. So you got retail stocks still under pressure, transport still under pressure, and the fact that they've recovered a little bit, okay, we've got the delay, but it's telling me the problem hasn't gone away.
They're still nervous.
They're still nervous in those key sectors. So what Walmart has to say, I think, is really, really important here because they've been a head and shoulders standout leader.
Okay.
And that's why I'm really focused on Walmart. Let's look at the broad U.S. equity market. So VTI is the Vanguard Broad U.S. Index. It's all the stocks in the U.S. last couple of years here on the charts. And you can see when we corrected very recently, we got back to the levels that were literally the peak of the market back in 2001, prior to the Fed raising rates and us coming under pressure in 2022, which was this down move. So the markets had a really good reset and correction. And I've talked about in my weekly YouTube blog for a number of weeks now that coming back up and getting above this 200-day average was going to be a challenge for the market. So we're here today. We've breached it. We can close above it for a day or two. We did that a few weeks ago before April 2nd, if you can see it there on the chart, just above the 200-day average. So can we hold this or not? If we can hold above the 200-day and the VIX starts coming back to the mid-teens, the market, broadly speaking, we're telling us we no longer need to worry about these economic headwinds. But when I look under the hoods at the key sectors that are more impacted, they're telling me a different story right now. So the market's recovered. There's some animal spirits. I'm not sure the whole message is telling me we have the free and clear, and I'm still very concerned. That doesn't mean the broad U.S. market can't keep grinding higher here. It very well could, but recognize that we're in an environment where it seems to be a bit more people, oh my God, get me back in, rather than we're free and clear, and the issues that we were worried about, we no longer have to worry about. If the retail stocks were firing and everything else, I will change my view on that. But right now, the problem areas are telling me there's still a problem.
Okay, so we're going to have to leave it there because I'm out of time with you. I was going to sort of try and dig a bit deeper into that, but those are the fundamentals you're watching, retail, transportation, and waiting for them to come back.
The real economy.
Got it. Larry, thanks for coming in. We will talk to you again next Monday. Larry Berman, of course, on Monday afternoon, 3 p.m. Eastern. Thanks for joining us. We'll see you again for the close coming up after a quick break.